Hi, this is the RITE Report program, and I'm your host, Chris Angle. I'm the author of 4 books on philosophy, one of which is the Philosophical Equations of Economics. And these books are available free for viewing at the philosophicalangle.com. Along with me is my colleague and co-host, Rick Samuelson. Rick graduated from Yale, has an MBA from Wharton, and is an independent venture capitalist out on the West Coast. Good to see you, Rick.
And you?
Approximately once a month, we put out a report on the state of the stock market and the economy. And the program uses as its basis the RITE Report, which can be seen at www.stock-market-direction.net. And the RITE Report generates indices from the monthly compilation of corporate, business, economic, and political news, and have a directional bias inherent within that headline. And these news indices are used as factors for prognostication of market direction. The RITE Report relies mainly on fundamental news analysis to predict the stock market direction for the coming month. Any questions or concerns, or you can email us at RITE report@gmail.com. So let's start with taking a look at the report, see what it comes up with this month. Okay. So let's go over the macroeconomic snippets. So the Conference Board Employment Trends Index declined further in April, following another decline in March. And the Bureau of Labor Standards came out with a CPI index, which decreased 0.8%. And the total U.S. business end-of-month inventories were down. And total U.S. business sales were down 5.2%. U.S. sales and food services had a decrease of 16.4%. Oh, that's a huge decrease. Gross domestic product is from, according to the Atlanta Fed, is on track to crater 42.8% in the April to June period, according to a running measure kept by the Atlantic Federal Reserve. A privately owned housing starts were at a seasonally adjusted annual rate of 891,000. This is 30.2% below the March estimate. These are huge downturns. The privately owned, it went down 11% here. The estimate of U.S. selected services total revenue for the first quarter was a decrease of 2.8%. And world trade was 1.4% lower in March compared to February. The real gross domestic product decreased 5%. The change was 0.2% lower than the advanced estimate released in April. The U.S. Census reported that new orders for manufactured durable goods decreased 17.2%. U.S. Census reported that the total construction activity for April was down 2.89%. Productivity decreased 0.9% in the non-farm business sector. Unit labor costs increased 5.1%. And so there were 12 of these snippets, negative snippets. On the positive side, real average hourly earnings increased 5.6%. And average hourly earnings increased 4.7%. And Real average weekly earnings increased 5.8%. In China, trade and production rebounded in March. Sales of single-family houses is 0.6% above the March estimate. Personal income increased 10.5%. Disposable income increased 12.9%, and consumer spending decreased 13.6%. In manufacturing, productivity increased 0.3%, and unit labor costs increased 6.9%. Total payroll employment rose by 2.5 million in May. What a surprise that was. And the unemployment rate fell 13.3%. That was pretty unexpected. So the positive news snippets were 6. So now we're going to go to the our economic analysis and indicator summary. High yield bonds went up. That's positive. The iShares Select Dividend ETF DVY went up. The ISM Purchasing Managers Index, it has a miserable score of 43.1%, but that's up from the previous month, so we're going to call it a positive. And same for the IHS Purchasing Managers Index, 39.8, but it's up from the previous month, so we're going to give it a positive. Construction spending was 2.9% below March, and so we're going to give that a negative. From the Bureau of Labor Standards, the unemployment rate decreased to 13.3%. That was a positive. Labor participation rate increased to 60.8%, positive. The employment population ratio increased to 52.8%. The employment trends index decreased. From the Bureau of Labor Standards, productivity decreased 0.9%, so there's a negative. The output decreased 6.5%. Productivity increased 0.3%. Okay, we got a positive there, but the output decreased 6.3%, so overall it's a negative. U.S. manufacturing corporations seasonally adjusted after-tax profits was up 7.6 billion, and that was a surprise. Advanced estimates of U.S. retail and food services sales at a decrease of 16.4%. The combined value of distributive trade sales and manufacturing shipments for March was down 5.2%. And the all-important industrial production index from the St. Louis Fed downticked to 92.5919. That's, however, it's still year-over-year positive. The downtick, another downtick of the velocity of money, and new residential construction. Let's see, this is 20.8% below March, so there's a big negative. Conference Board leading economic indicators decreased, as well as did the coincident economic indicators. New residential sales, however, is 0.6% up. New orders for manufactured durable goods decreased 17.2%. huge. Existing home sales down 17.8%, huge. Real GDP first quarter down 5%. Oh, or that's a negative 5%. Negative 5%. Personal consumption expenditures are down 13.6%. Personal income, as we mentioned above, is positive 10.5%. Consumer confidence index increased, amazingly. And the restaurant performance index below 100%. So it's the restaurant business is imploding or decreasing pretty rapidly. That's down from over 100%, which marks an expanding industry. Corporate profits decreased 295 billion, and manufacturer shipments, inventories, and orders decreased 57.5 billion or 13%. And world trade was 1.4% lower in March. So pretty miserable out there. Only 9 positive economic indicators, 17 negative indicators. And so if we go into taking a look at our strategy index and how we formulate that, we can make an estimate of the domestic political risk. The tax risk is, well, that's pretty positive because corporate taxes were cut, regulations are decreasing, governments are making a huge infrastructure and stimulus packages for the economy. And technical analysis shows that the market has reversed from its downward trend and is now on an upward trend. And the general business and economic snippets, though, are way down, and as are the economic indicators. But the economic indicators actually are a little bit better off from last month, going from 5 positive to 9 positive. But still pretty tough out there. So, but nevertheless, the RITE index went up from 71 to 76.4, and therefore we're going to state for the market conclusion here that last month the RITE report stated that economic crisis will start to clearly abate shortly, and remarkably it has reversed and is actually getting better, albeit it is still in tatters, that is the economy, but at least it is no longer degenerating due to the China coronavirus. So the market will continue to advance incrementally, and so we recommend to go and stay long with your investments. Let's go to Rick and see what he has to say about the economy and the stock market in the coming month.
Well, I would note also that gold has peaked and is heading down, so as a proxy for risk and generally perceived risk in the market, that is diminishing. So we are in a risk-on phase, broadly speaking. Interest rates are structurally negative in real terms all around the advanced industrialized world. So that begs the question, where else would you put your money but the stock market? I mean, there might be some commodities plays out there that are worth investing in, but that's not as large a market opportunity as the stock market. Real estate is also another opportunity, at least on the residential side. I don't think anyone believes an investment in commercial real estate at this juncture makes sense. I think there are structural transformations going on in the economy that will ensure the following: high structural unemployment, because certain industries that are heavily dependent on labor will not recover quickly, including commercial construction, retail, restaurants, travel, airline travel, cruise ships. The list goes on. These are services that will not recover to anywhere like they were a few months ago, this year or probably next. That's a given. Finally, I would add that it's not being advertised widely, but there are a couple of indications at GE and other companies that they have viewed the opportunity to lay off people as a welcome chance to prune. So what I find interesting there is that downstream, perhaps next year, we may not see it in earnings this year, you may see a general boost to earnings because actually fewer people are working in these companies, and yet they're able to maintain similar levels of revenue, if not growing revenues. So the silver lining in some of the unemployment figures is that corporate earnings at some point are going to actually improve just because fewer people are employed and these businesses are managing to remain as productive or nearly as productive as they were before. That said, I think at a policy level, the implications of massive unemployment, which is what we have right now, shouldn't be underestimated. I don't think it's any secret that one reason the riots going on today are so severe is you have so many people out of work. And as long as that remains the case, as they say, the devil makes work for idle hands. These kinds of problems are going to persist and be disruptive. So we've entered into politically a very challenging environment. At the corporate level, I think the drive toward automation, toward using fewer employees, toward conducting business online, toward having fewer meetings face-to-face, I don't think that's going to alter anytime soon. People like working from home. I think the tech industry has migrated very rapidly to a completely decentralized model in which a new, call it a paradigm, I hate to use that word, call it a paradigm, where people are expected to work from home. And the face-to-face interaction will be occasional. It'll happen, but it won't be a daily grind. You won't see the number of tech workers commuting that you did before. And all of that has implications for how much oil the country requires, how much gasoline, how many cars it will require, what the level of mass transit is that will be needed. So these are massive structural changes that won't return us to the prior model anytime soon. How many stores are you going to need if half the population orders everything online from Amazon? These are open questions that companies will have to grapple with.
So, Rick, you mentioned that some services will not recover quickly. Why is that?
Well, in the instance of the airlines, if I can get business done more efficiently through a Zoom call rather than going to meet somebody in New York, why wouldn't I load up on Zoom calls, try to close more business, rather than take a costly and time-consuming trip to New York?
Okay.
I mean, that is possible.
Right.
It's the rational approach.
So ultimately, what do you feel about the stock market and the economy going forward 1 month?
Well, where else is the money going to go?
Okay.
Where else can you put your money? Look, I think the market, the NASDAQ's hit all-time highs.
Right.
Is that justified? Probably not. So we'll probably see it kind of pull back over the summer. But as ironically as the safest place to put your money at a time like this, I think the stock market looks pretty attractive. And the plays going forward will be in other countries where perhaps the recovery isn't as quick as it is in the United States. You may see other international stock markets. Some have already bottomed and appreciated, but not as much as the U.S. The U.S. is leading the world in this respect.
Uh-huh.
And so there's going to be ample opportunity to invest in other stock markets around the world where, frankly, the same conditions apply. Interest rates are, in real terms, negative. All the other same commodities conditions apply. Everyone's experiencing the same problems, and a lot of companies have moved online.
Okay. Thanks for that summary, Rick, and we hope everybody will join us again next month for the next edition of the RITE Report.
Thank you.
Thank you.